Milan. We're going to be doing dividends today. When it comes to dividends, note that dividends is simply a return to shareholders for their investment in the company. So shareholders, every investor invests their money into something because they will want some sort of a return. So you don't just invest money for the sake of investing money. You invest money in order for you to get a return. Now, as a shareholder, when you have invested money into the company, the return that you expect to receive from the company will be what we call dividends. What are dividends? Dividends are a portion of profits, remaining profits, after taking interest into account. So once you have earned profit for the year, part of that profit will go to the lenders, which are the creditors, as interest. So the first people to pay will be your lenders, which are creditors. You pay them interest. And from the same amount of profits, you need to pay SARS, which is your income tax. And then whatever is left will be what we refer to as net profit after tax. That's why we say normally the equity holders or the shareholders are the last people to get anything from the company. They're the last people to be paid. So whatever is left as net profit, that's what you will get as dividends. Now, what are dividends? Dividends is simply a return that you get by investing into a company. You invest in a company or buying shares. So dividends are simply returns to the shareholders for their investment in the company. Okay. Remember, to be a shareholder, you need to have bought shares from the company. So you can't just be a shareholder and you know that you didn't buy shares. A shareholder means that you're holding shares in that company. Needless to say, you need to understand that dividends will only be calculated on shares that have been issued, not authorized, but shares that have been issued. So when dividends are declared at that specific point, you need to check how many shares were issued at that specific point. Unless adjustments tell you otherwise that certain shareholders do not qualify for dividends. When certain shareholders do not qualify for dividends, it means that when you calculate your dividends, you don't include their capital amount. Now, question is, how do we calculate dividends? Dividends are calculated as a percentage in cents of the number of shares issued or a percentage of share capital. Now, you need to understand there's a difference between shares issued. That is just the number of shares. Share capital is the capital that has been raised, all right? So for you to get share capital, you took number of shares issued, you multiplied them by the share price. Whereas number of shares issued is just the number of shares without multiplying them by the share price. So you need to draw that distinction between shares issued and a percentage of share capital. That should be shares issued. All right. Now, share capital will simply be number of shares issued multiplied by price per share. By now, you should know that I told you what price per share is in previous videos. Check out previous videos if you want to know what price share price is. Now, now guys, I'm just going to show you. I think that was not supposed to have been share capital. It was supposed to have been dividends. Okay, dividends per share. Normally, dividends per share will simply be a percentage, and that percentage is normally expressed in cents. It's a percentage multiplied by the number of shares issued. As I've said, dividends declared will be number of shares issued. You multiply that by dividends price per share. Now, when declaring dividends, to declare something, it means that you are sort of creating a contract. Remember, contract can be verbal and can be written. In most cases, when companies declare dividends, it's in writing. So you're promising the shareholders that you are going to pay them dividends, either at that moment in time or later on. And immediately when you declare dividends, you are creating a liability on the part of the company, because those dividends, you are required to perform your duty, which is to pay them to the shareholders. So when you declare dividends, you are creating a current liability where you are simply promising shareholders to pay them dividends within a period of 12 months. That is why when we declare dividends, if we don't pay them, we actually recognize that as a current liability in trade and other payables. Okay, before a company may declare dividends, though, the liquidity and solvency ratio must be met. Remember, liquidity refers to the company's ability to settle short-term debts, and solvency refers to the company's ability to settle long-term debts. These two must be met. And once the company declares dividends, as I've said, it is obliged, meaning that it is forced. I don't want to use the words forced, but it's obliged. It's under an obligation to pay those dividends. And that's why we recognize it as a current liability if the declaration has happened, but the payment has not yet taken place. All right. Now, we have two types of dividends, okay? We've got interim dividends. Interim dividends are dividends that are declared during the financial year. These are dividends that are declared and paid by the company during the financial year. Now, declare and pay means that there's no liability. Created the liability and got rid of it by making a payment to the shareholders. Note that dividends is a way of returning money to the shareholders for investing into the company. So far, you know that the company can return money to the shareholders by buying back shares. Another way, guys, a consistent way the company must actually pay dividends. And note that a company that declares and pays dividends also sends a positive signal to the market that they've got money and their liquidity ratio is on point, their solvency ratio is on point. Therefore, that could result in the company's shares going up. When the company doesn't declare dividends, then you might be concerned because that might mean that the company hasn't met its solvency and liquidity ratio and the company does not have enough cash or enough profits to return to the shareholders. And that could be very disappointing to the shareholders. Remember, as a shareholder of a company, the reason why you invest in that company is because you want sort of a return from the company. And if you don't get that return, you might actually opt to invest in other companies. All right. And then we've got final dividends. What are final dividends? These are dividends that are declared by the company at the end of the financial year. They are classified as current liabilities and will be recorded in note 9. The note number really doesn't matter. What matters is that it will be recorded in trade and other payables note. It is a current liability. So final dividends will be recorded in trade and other payables note. Since it is a current liability, the company is obliged to make a payment with respect to those final dividends. All right. And then we've got dividends on ordinary shares. Dividends on ordinary shares, okay, are simply your total dividends declared and paid for the current financial year. Dividends on ordinary shares are total dividends declared and paid during the current financial year. Now, how many dividends does the company declare or pay in 1 year? It declares 2 dividends, which is your interim dividends as well as your final dividends. So we can safely say dividends on ordinary shares are just your interim dividends plus your final dividends. I hope you got that. Dividends on ordinary shares are just your interim dividends plus your final dividends. Then we've got retained income. Others call it retained earnings. Retained income or retained earnings are simply the profits that we have retained in the company for future use. We normally use those profits in the future to pay for the buyback, to pay for dividends, and to also pay for tax in case we don't have enough cash in the future. So those are the reserves that we keep within the company. But it's high risk to have a lot of retained income because it means that your profits are just there sitting in your statement of financial position and you're not using them. So the company can take the retained earnings and make more return by investing it elsewhere. So that is the risk. Okay, but retained income, a company with a higher retained income could be seen as a company that is doing very, very well. Obviously, it's making profits. Okay, unused profits, simply that's what it is. Retained income is just unused profits that will be used in the future to pay dividends and tax. These are accumulated amounts of profits that the company has not used over the years since from its inception. We're going to be doing this example in the next video. Please check out the next video.